Welcome to the Financial Freedom Summit. I'm Monica Jazik from RPI Education, and in this series, you're going to hear from 21 experts sharing powerful wealth building strategies that 98% of people are not using. These interviews are packed with real actionable steps to help you fast track your financial freedom. So let's jump in with today's guest, Trevor Colton. Trevor, how are you doing?
I'm good, Monica. Thanks for having me.
I'm so excited you're here, my longtime friend, amazing expert. I'm going to read a quick bio that you sent to us here for our audience. So, Trevor is a longtime veteran of commercial real estate and mortgage banking with deep experience in real estate finance, real estate acquisitions, financial analysis, loan underwriting, investment sales, capital markets, and asset management. Since 1997, Trevor has $5 billion dollars of commercial real estate acquisition experience. He has overseen more than 6,000 units of multifamily housing and underwriting billions of dollars of commercial mortgage loans. He was also a professor of real estate finance in the Masters of Real Estate program at Portland State University, and he's trained thousands of real estate investors, agents, lenders, and other professionals in real estate finance and investments. Wow, Trevor, this is quite an impressive biography here.
Yeah, thank
I
you.
love it. And I love your courses. So, although Trevor is a total math guy, and he's going to show us some pretty cool examples today. Although he's a total math guy, he has this amazing talent of breaking down complicated information very, very simply with use of his beloved blackboard that he's going to actually be showing us today. And all of his courses are like this to really simplify things, to make these sort of financial concepts and the math behind real estate investing very, very digestible for normal people. And I guess that comes from years of being a university professor, right, Trevor?
Actually, the university came to me and said, You need to be teaching in our program." So I think I just have a philosophy that if you are trying to communicate something to your audience, you need to meet them where they are. And for non-finance people, it's incredibly valuable when somebody takes the time to convey their concepts in a way that's, like you said, digestible and easy to understand. And that's actually how all of this came about. One of my clients asked me if I would come and guest lecture in his master's class. And after I did that a few times, he said, "You need to be teaching this class." So I did that for fun. I taught in the master's program. I taught real estate finance and investments for 9 years. I just did it because I really enjoy working with people and I like the interaction. And much like the RPI students, they're motivated, they're hungry, they're intentional, and it was really rewarding. I did that all the way up until the pandemic.
That's amazing. And they probably appreciate really having someone who's so invested and someone who's actually done this. And I know there's a lot of professors because my oldest son is studying finance as well. And it's a struggle when you have a professor who's not, one, invested in teaching the content. And I remember back to my university days, some profs come in and read from their own book, and that's it. There's no real, explanation or really passion about it. And two, how often do students look at their professors, whether they're college or university professors, and say, well, what business did they have? Or what have they actually done in investments rather than just studying about it? And I think there's a huge difference, as I always say, learning really is through doing. And you have actually done all of this for years and years and years. You have a very extensive work history in this. So let's start off by asking you the first question, really, of what is the wealth building strategy that you'll be talking about today that you've used that has created financial freedom in your life that most people do not use? And why do you think it is so underused?
My personal strategy that I discovered fairly early on as an analyst, I had the opportunity to look at all kinds of product types, commercial, residential, every real type of real estate investment you can think of. My personal favorite is value add multifamily. And I chose that strategy because it checks all the boxes for me. I I don't have the risk tolerance or the stomach to wait 2 years for a development project to finally start cash flowing. I like to buy things that are cash flowing from day one. I like value add because I have an affinity not only for like classic architecture and culture and preserving history, but I also have a passion for expanding and improving the housing stock for everyone. I do a lot of volunteer work with homeless youth, and I I want to be a part of making more quality housing available for people. And it also just happens to be on a risk adjusted basis, one of the best returns that you can get in all of real estate. So that's what I've been focusing on. I still consult for a lot of different types of investors and owners and developers, but my personal strategy is value add multifamily.
Yes, that's a great. Why do you think it's not underused? Why do you think that's not a more popular real estate investing strategy that most people do?
It it's not completely unknown. There are definitely people who love that strategy, but the barriers to entry into multifamily are a little higher, and the financing requires a little bit more skin in the game, so to speak. So it can be a little bit daunting for people who want to get out of the Burr method or, having single rental houses when they find out that they have to put 25 to 35% down, and the underwriting is different, the loan terms are different. it I think there's a learning curve there. And then a lot of people, the way they look at multifamily is as if it's just more doors without understanding the economies of scale. So I think people who are accustomed to single family or like rental houses, I think they look at the amount of work that they're putting in and think, gosh, if I had 20, it would be 20 times as much work. And a lot of people don't really understand it. Once you get over the hump of a certain number of units, it actually does become more passive.
Mhm.
And I've been through that in all of those stages. And now like, I wouldn't say it's passive, but my role is primarily as an asset manager rather than a property manager. So I'm not, painting or, cleaning toilets or I'm not doing any repairs. I'm not swinging a hammer. So
You have property management for that, and you have to run that team. You mentioned a certain amount of doors. Once you're over a certain amount of doors, how many is that?
well, it depends on the market, but that's a great question.
Mhm.
And the answer is it depends for me on the availability of quality management in that market. So, for instance, I just had a client who bought a 27 unit, and it was their first acquisition in what I would call a secondary market, not a big city, but not a small town either. And they were able to find a handful of really good quality property managers that had experience. They had teams, they had systems in place. So, as a general rule, I think that if you are below 20 to 30 units, it can be really challenging to find professional management and still make a profit. A lot of times when you're in that under 25, say, units, you can choose to make a profit or have somebody else manage, but you rarely can do both.
Mhm.
And that is part of that sort of daunting part that we were talking about, where once you get over that point, now, if I'm looking at 50 or 100 units, that is the type of property that the best managers in the market are going to want to compete for that contract. And so we're interviewing them. We are taking a look at what kind of systems do they have, what's their reporting, what does their leasing team look like, what does their maintenance team look like. And that is, I think, probably one of the lesser known factors within the multifamily space, especially for
Right.
newer investors.
And so would these investors for 50 to 100 units, are they buying them on their own, or are you helping people like learn how to raise capital so they can buy it with others? Or what do most of your deal structures look like for yourself as well as for your students?
Great question. So for me, it's always to the greatest extent possible, and this is what I tell all of my students, is use other people's money. And we know that in real estate because for the most part, we're using the bank's money, right? So we're already in the mindset to be using other people's money. But when when you're starting out, you're not going to be looking at 100 units. You might be looking at 6 units or 10 units, and that's okay. And actually, that actually justifies the reasoning for finding a team and pooling your money together, or at least finding partners, and each person or each investor contributing whatever their best resources are. Some people might just have capital to invest, but they don't have time or skills, knowledge, what have you. Other people might not have capital, but they've got great analytical skills, or they can help with maintenance, or any of those 20, 50 different things that people have to do to manage, own, and acquire real estate. It always takes a team. And so you should never be doing it with all of your own money, and you should never be doing it all on your own with your own time and resources.
Right, right. No, great answer. Great answer. So tell us, let's take us back before we get into a live example here. Of what were you doing to build wealth before you entered the wacky world of real estate and investments and mortgages and whatever? What were you doing wealth before you started using this multifamily strategy? And what pivotal moment happened in your life where you just knew like you needed to make a change?
Great question. So I think my path has been a little unique because I always knew that real estate was interesting. And when I was a kid, I thought I wanted to be an architect. And I grew up in Los Angeles, and I would just go down into the city and just look at these giant skyscrapers in awe. And when I was in college, I knew my long-term plan was to eventually be a real estate investor, but I didn't really have a path yet. And so I worked in mortgage banking, and that's where I got a lot of acquisitions experience, and I was an analyst. So I got some really great fundamental finance training.
Mhm.
And the biggest thing that happened to me was the big stock market crash after Y2K back in 2000, 2001. And I had all of my wealth building, so to speak, in the stock market and lost 80% of it overnight through no fault of my own or anybody else's. And so then I realized, okay, this is time to, I'm not going to try and replenish that. This is time to start really thinking seriously that real estate needs to be the plan, not just a dream. And uh, not too long after that, I decided, okay, well, what's next? I already know how to analyze real estate, but I didn't know anything about transactions or doing deals or writing contracts or negotiating or due diligence or any of those things. So I went and joined a brokerage firm, and I decided I was going to go just figure it out. And I actually thought I was going to go into lending. And the owner of the company, when I was interviewing, is like, "Well, I don't have a lending spot open, but I happen to own a real estate company." And he's like, "I think you would do quite well." And he was right, because as my first year, I finished as the top producing broker out of 30 agents because I was able to speak finance, and I was able to not only put deals together or spot deals that wouldn't work really quickly, but I was able to convey the financial strategy, the capital strategy to my clients. And that really resonated with them. And I didn't know it at the time, but real estate finance is it's been a part of me for a long time. So I did quite well. And then once I understood the transactions and I would see how other investors operated or what their strategy was, some people were developers, some people had, everybody's got a unique strategy in a unique market, right? I realized, okay, here are the things that I do and don't want out of my real estate investments. And one of them is I'm not a person of trades. I don't know carpentry. I don't know plumbing. I don't know electrical, but I do know finance. So I decided I was going to go after those things that I could not take too much risk, because I didn't want to lose 80% of my value in anything ever again. But I wanted to be able to create value, and I wanted to be able to create that value with my own actions or my team. And I wanted to be able to control that. And that's the beautiful thing about multifamily and commercial. You're not just reliant on, the market appreciation. The housing market is up, and you're kind of hoping that you're going to get a certain price on exit. In commercial real estate, values are determined by the income, and that includes multifamily. So you know that if you're able to increase the income on a multifamily property, you know pretty close how much you're increasing the value. And that makes planning your exit strategies easier. It makes the financing easier. It just, to me, it's very quantifiable. And I like that. I like being able to predict what's going to happen by just understanding the math.
Yes, it's a lot more certainty, because I think a lot of the reasons why people do not invest in real estate is because of the uncertainty, and they are not sure. And I think the biggest weakness for most people entering real estate is their uncertainty towards numbers. Whereas in reality, numbers as a real estate investor, whether you're a strong math student or a weak math student, numbers are your best friend because they do not lie and they don't go for best case situations. I always say you need to map out to our students a worst case situation, a best case situation, and a most likely, and go bank all your results on the worst case situation, because then you're always going to be happy and prepared for the most likely situation. And I think preparing for these what ifs, especially with things that have happened in our economy ever since COVID and everything happening in the real estate investing world, being able to prepare, you cannot do that with any other investment. In 2008, we woke up and, this huge crash and all of our stuff were gone. And it was just same as you. It was like over 80% would just disappeared. We had no control. There was nothing we could do about that. We couldn't sit there with our mutual fund advisor and plan this out in advance and say, okay, what's the likelihood of this happening or that happening, or how can I mitigate my risk? You could do it in private markets, but not with mutual funds, because they would say, I don't know, that's the point of mutual funds. We're spreading out your risk. And so
Yeah.
it's crazy. I absolutely love that. And it's amazing how if you know your numbers, you really can feel empowered. And I love how you're simplifying the numbers to really make everyone feel empowered and not scared of numbers. People have to really face their grade 11 math phobias and make
I
math
tell
accessible for
everyone
everyone.
it's easy to forget that real estate is a financial investment. And we see the brick and mortar and the land and everything around it, but we forget that it's still a financial investment, and that means that understanding the finance is critical.
Yes, absolutely. Numbers don't lie, people. Know your numbers. Don't be scared. We all have courses here to break those down for you. Okay, can you walk us through your strategy and show us kind of how you use this strategy to fast track your wealth and create financial freedom in your life?
Sure, sure. Um, I will outline what I see, not just my strategy, but works for really most people, and it's very predictable. And um, so imagine let's I'll paint the picture for you, but let's imagine that this is time, okay? And this is a path that a number of my clients have taken. Mine wasn't exactly this path because I was already in the industry, but it's very common and it works really well. So let's say that here's today and you've got, 4 doors. And with that, maybe we can just make up some numbers, but let's say that you're grossing, I mean, it doesn't even matter really, but you're making a certain amount of income. And as we all know, that income is relatively capped. You can't do much about it. You might have some appreciation there. You're going to get a little bit of income, hopefully. But the more that your market is appreciating, that is equity on paper that doesn't really exist because it's trapped, it's not being used. So, but let's say that you had put some down, and I could, I don't want to date this by putting numbers to it because a year from now, those numbers will probably all be doubled. But let's just imagine that this was, $1 million. So we're probably talking about Vancouver, BC, um, and you had put, let's say, you now have a $500,000 in equity, and that's because you've held on to it. Well, if you take that and you sell, and then you go and you re-leverage let's just say you had 500,000 here. Well, you take that, re-leverage it again. Now you could buy something for 1.5 million. And you've used leverage, but you have your equity. But now if you're in commercial, if you're multifamily, let's say this is even an 8-unit, it doesn't really matter how many units it is, but I would probably look for something that a little bit more scale, more doors. So if this was, we'll call it 10 units. Now this is where multifamily gets really interesting, because in the commercial world, value is determined by the income divided by the cap rate. So you've probably all heard these terms, but the income is whatever is left over after paying all the expenses, but before paying any loans or anything, the net operating income. So now, if you think about a 10-unit property, if you're able to increase the income by, say, $50 a month, well, $50 a month translates to $600 per year. And in the case of like rising rents or reducing expenses, that doesn't change anything else. All of that extra income goes straight to the net operating income. Well, what I always tell my clients, an easy rule of thumb is every $50 a month equals $600 a year. Well, if you divide 6 cap, if you take $600, divide it by 6%, that equals $10,000. So every $50 of income that you can create per unit in a 6 cap market equals $10,000. So here, if I was able to just achieve $50 of increase on 10 units, I have now created, you can do the math there. In this particular case, I've created $100,000 of value. And I was able to control that, okay? So now imagine we've got a little bit of time. Now I started out with 500 in equity, and I still have 500 in equity, but I've now created additional value. And let's say we do that over the span, we do that each year for 5 years, okay? So now, 5 years later, I have created $500,000 in value on top of my original 500. I've doubled my equity.
Mm-hmm.
So now I have $1 million in equity. And I go back and do it again. And this is the cool thing about multifamily is if I do that same thing again and I could leverage 2 to 1, now I can buy a $3 million property. And understanding that, when you sell and reinvest is when you realize the value that you've created. And I had a client, one of my very first clients, he had 4 units, and it took him 10 years to get up to 18 units. He only had, and this is the case study I have on my website, He only had all of that. He and his wife, they did all the management. They spent a decade, and they were able to trade up into an 18-unit property. And by this time, he was going on a dozen years as a real estate investor, but he had no leverage. He was doing it all himself, and he didn't leverage. And I said, well, why aren't you leveraging? And he said, well, I don't want to be in debt. Debt is bad. And I said, I agree with you. Credit card debt is bad, but real estate leverage is a tool. And I walked him through the math. 6 months later, with no money out of pocket, he had 90 units. And when I called him, he said, Trevor, technically I'm a millionaire, but I can barely afford to buy a broom. He was driving 3 hours to manage his property. 6 months later, he owned 90 units, 10 minutes from his house, professionally managed. A couple years after that, we refinanced him into a long-term HUD loan, which is similar to, like in Canada, the MLI Select. And he was cash flowing over $500,000 a year in
Wow.
2 steps. So the one thing that I think is really scary for a lot of new investors is understanding it's not just when you buy, although when you buy is really when you know how much money you can make within certain parameters, but it's when you take the value that you've created and you redeploy it. So in this step, you might have started out with a couple $100,000, and next thing you know, you've got over $1 million in equity. And this is not pie in the sky. This is with very realistic, reasonable increases in income. And I'm not a proponent of inflating rents on residents. I'm a believer in providing quality housing, at a fair price. But this is the path that I think when people think, oh, I want to build wealth in real estate, you only build wealth in real estate 4 ways. And that's through appreciation, obviously cash flow, principal pay down on your debt, and tax benefits.
Yep.
This right here is just the appreciation part. So there are a lot of different things that, especially in commercial real estate, a lot of different levers that you can push and pull depending on your unique strategy.
Okay, so I'm like loving this because usually people say value add and you think, oh, I need to fix it up. And we do that a lot too. But there's no work here to be done. It's all with strategic rents and improvements based on the cap rate. And it's also, your refinance is also not based on keeping the existing property. It is based on a sale and then using that leverage from that sale to scale up and buy the next one, buy the next one, buy the next one. I know everyone's going to ask this question, and I know it's an additional question here. What does that mean from a tax perspective now as well? Because in Canada, I know that would be a bit of a tax hit. In the US, you have more options. I know you're in the US from your own experience in regards, as a lot of Canadians are doing US real estate as well, and vice versa. What does that look like as a US person for a tax perspective when you're selling the properties and buying the next ones? Are you able to do some sort of rollover and defer taxes?
Yes, absolutely. In the US, it's called a 1031 exchange, and it's very common. And all it means is when you sell, you don't touch the cash. And I have a lesson on this on my YouTube channel and as part of my courses, but it just means that you don't touch the cash when you sell. You give it to what they call an accommodator or a third party, and just like escrow. And then when you find your new property, they put that money in. So as long as you don't take what they call constructive receipt of the funds, you can roll your investment into the next property without any capital gains liability, and your original basis just carries forward.
That's just so powerful. And I think
Mhm.
Canadians can't get 100% of that. But if the money, like what you said, we're not using the money and it stays in the US Corp, that it's less. If we were to take $1 million from the US to Canada, well, that's going to be a big tax hit based on how you're structured. But we always focus on the use of proper corporate structures. This is more of an accounting question. But as long as you're not capitalizing on that gain and the gain is there to purchase other investment, the tax repercussions are not as good, but more minimal than what we would what we would normally get. So that's fantastic. I love this strategy. I love how you're able to coach on it and advise on it and make it so achievable. And it's amazing. It's absolutely incredible. Now, if you were starting from scratch today, no followers, no capitals, no connections, what secret move would you use to get ahead fast?
What secret move would I use? I would, the first thing I would do is what I think a lot of your students are doing, which is I would get educated. And I gotta, give you some kudos for what you've built with RPI, because it's so valuable and people need the skills and the knowledge and the understanding. And I do my part on the finance side, and that's the first step. So I think getting the education and then finding that community, that network, because those could be your partners. And if you don't have any capital, it doesn't mean that you can't go out and do something. I didn't have any capital on my very first deal, but I offered to help and I got a lot of experience. I actually learned a lot of things that I didn't think I had to learn. I was quite surprised. And so that second part there is finding other people who share your same goals and teaming up. And I think a big problem that a lot of people face is they think, oh, I'll never get there because I don't have a $250,000 to get started. And I think that they underestimate how many people out there, they have capital, but they don't have other things like time. They don't have skills. And so I can almost guarantee that no matter where anybody is on their journey, there's somebody out there that is looking for what they have to offer.
Yeah, and you just need to connect the two. And I like how you also said a lot of people feel, and that was a question, what's a misconception people have? I don't have any money. But we show how to strategic leverage from your house as well to buy, like you said, that first investment. So maybe people could use the funds from their primary to buy an investment, and rather than buying a single family home or a condo, which no one should ever buy, to buy that home, buy a multi, and rather than doing the BRRRR strategy or doing the fixed component, which is getting a little riskier this day and age, um, focus on your strategy of improving the cap rate from an income approach. And then from that, scale from that and really kind of know exactly where you're going and do it more in a sale approach rather than a refinance. Very Robert Kiyosaki, Monopoly, four
Mhm.
houses, and then buy the hotel sort of thing.
Well, the path that I took, I knew that I wanted to be involved in real estate, and I was studying business, and somebody along the way when I was young said, well, if you want to be successful in real estate, you got to understand the finance, so you might as well start there. And that was why I went into mortgage banking when I got out of college in undergrad, and they were absolutely right. And the bigger lesson outside of just the finance, because I've learned that lesson over and over. I learned it in brokerage when I started doing deals. I was a director of asset management for the housing authority, overseeing the 6,000 unit portfolio. I learned a ton about asset management and low income housing and things like that. Obviously, have learned a lot about lending. So it doesn't matter where you go to learn first, as long as you're in the mindset that you're never going to stop learning, you have the chance to be successful. There is no finite amount of knowledge. It is always something new. I've been now I'm coming up on 30 years in the industry, and I love that I'm still learning new things. And in some cases, things are changing faster than they ever have before. So people who want to get into real estate and they want to build wealth in real estate, figure out a little soul searching maybe to what you're good at, what you're interested in, what you have that appeals to you, follow your gravity and go learn that, and then master it, or at least become proficient, and then go learn the next thing. And along the way, there's so many intangibles that you're going to acquire, like a network and skills and perspective. And you will also understand like how your values are changing over time. And that will help you narrow down your strategy.
Yeah, absolutely. And your strategy will change as the math is changing
Yep.
too. So, like we need to make sure as things change in our economy, things change in time, is our strategy, our initial go-to strategy working? As a real estate entrepreneur, you always have to stay current and you always have to be able to pivot. And I love that with our courses and your courses is everything's in real time and current. We're not like 1980s trainers teaching people how to invest way back when, and we have no idea because we're just selling courses. And so it really, the strongest thing really to know also is the math. And if the math's not mathing, then you need to really tweak and fix that strategy. And then maybe you come back to that at another time. It starts working again, depending on that environment. Or maybe you need to change your strategy or change your investment model and make
Yeah.
sure those numbers work. So I love the fact, I think it always comes down to your amazing financial mathematics courses that everyone, even if you hate math, you need to know your numbers and understanding those components of ROI that you broke down. You said there's only four ways to make money in real estate investing. People need to understand what they truly mean because old-fashioned advice will say, I buy a house, I pay down the mortgage, and I live off the rents. And that does not work, especially with single family anymore. You would have to have 100 properties. Rather than have
Right.
100 properties, have a building with 100 units.
The thing that I totally agree, and the nice thing about what I do in multifamily is it's scalable, and anybody will tell you, and anybody who's going to invest in you, and I say you as a people in general, whether it's the new killer app or a business, a brick and mortar business or real estate, they want to see that what you're doing is scalable. And you mentioned the math, and the thing that I really like about that, I used to tell my students on the first day of class every day when I go, I was like, hey, just so you guys know, I need to confess, I'm not a real teacher. I'm just a real estate guy that loves teaching. And I'm going to come and approach all of this because we were using a textbook that was around forever. I said, the nice thing about the finances, the fundamentals don't change. But if you don't understand them, you're going to be floundering and running around trying to figure things out forever. But if you get just this handful of concepts and you really understand them well, it will open up a world of possibilities for you. And I told them, I said, a lot of the things in this textbook that I am required to teach out of are outdated. So I'm going to hone in on the things that I use, that I see in the industry, that I know, and we're going to focus on those. And by the time you're done with this course, you're going to master them. And I'm still getting from students I had back in 2011. A lot of them are executives now. Many are still in the real estate industry. I'll get the occasional LinkedIn message that says, I still use my calculator that you taught us how to use every day, the financial calculator. And people love when I run into them at events. They get excited how I am able to articulate my strategy and back it up with numbers with just my phone, where other people can't have that conversation without opening up a laptop and getting into their spreadsheet that they're not really sure how it works and they hope the numbers are right. And so again, like the strategy, the finance, the understanding and being comfortable with all that, it's all related.
It really is. It really, really is. I love that. Now, one last question for you. Actually, we'll have two more questions here. What do you see the top 1 to 2% wealthiest people and families doing consistently that the rest of the world ignores or avoids?
Great question. The first thing in the context of real estate are systems. Understanding that you need to create a system, and this could be a system of how you're finding deals, how you're analyzing deals, how you're making offers, doing due diligence, how you're managing, how you're deciding when to sell. you have to have a system, and the system needs to be based on your strategy. And a lot of people think when I'm going to go out and I'm going to find a piece of real estate and I'm going to develop a strategy around that, that is a recipe for driving yourself crazy. And what I have my students do is we do an assessment like, what are you good at? What are your resources? What are you capable of? What are you willing to do? Are you willing to fly to another market? Or do you just need something local? And we say, okay, based on your values and your goals, here are the strategies that would fit into that. Some of them don't. And then from there, you pick one or two. It's okay to have more than one, but and you're also allowed to change it, but you have to have a strategy. And then you go and you find properties that fit your strategy, not the other way around. And so I think that the people who are really successful would be, they're the ones that they dial in what they're doing, and then they build a system for each part of it. I can analyze a potential acquisition in minutes, like under 2 minutes. And if I really need to run the numbers, I can do it on my phone because I know how to do that with the financial calculator, or I can plug it into my like sort of like deal evaluation calculator. It's like a handful of metrics. I can plug in a few numbers, plug in a few assumptions, and does this fit? Cool. And if I, before I had like knew that I wanted to do value add and I knew I wanted to do multifamily, before I had a system, I was analyzing every deal under the sun. I was going crazy. I'm like, well, maybe this will work and maybe it won't. And I don't have to waste that kind of time anymore because I'm realistic about what I can do and what I want to do.
Absolutely. Yeah, focus is paramount for sure. So is there anything else you'd like to share with our audience? I know you have a free gift that you are offering it to our audience as part of this webinar.
I do. I'm here to support RPI, and I'm not going to go and do a bunch of shameless plugs of my academy, but I am the founder of Real Estate Finance Academy, and what I teach people is how to analyze real estate and their strategies. And I thought that I know a lot of the RPI students want to get into multifamily, and some of them are looking at multifamily deals. So what I did is I created a multifamily due diligence guide that has a full checklist and all the things that you would need to ask for a seller if once you get in contract for making an offer on a multifamily. Because what I thought might be valuable to your students is something that's going to help them reduce risk and go forward confidently into that deal saying, I've turned over all the rocks, I've looked at all the bones, and I know what's happening with this property. So I created this, it's like a 10-page ebook, but it's got kind of everything you would need to do professional level due diligence on a multifamily property.
I love that. Thank you so much for doing that, Trevor. So audience,
Yeah,
make sure the URL is going to be attached to this email where you're watching this video. Make sure to click on that, download that. Thank you. That is such a generous gift and so helpful. I've really enjoyed our conversation on this interview.
I
And
appreciate you having me. Thank
oh,
you.
thank you so much, Trevor. It's always so great to have you. And thank you, audience, for tuning in. And stay tuned for our next interview tomorrow with another specialist talking about their wealth building strategy. We will see you soon. Bye, everyone.